Good afternoon, everybody. Welcome to TraderMerlin Show. It is your Friday edition. It's the weekend, everybody, and I actually made time today to make sure that I grabbed a nice glass of whiskey. This is a well-deserved one for myself. I hope you all earned your whiskey this week, or your beverage of choice if you're having some orange juice. Cheers to everybody. Happy Friday. I hope you had a great trading week out there. Now, I just mentioned, Bibb and Tucker. Such a good bourbon, 6-year bourbon, which is very rare. But I was mentioning at the top that it's been a good week. And the reason I say that is you look at a lot of these market indexes and pretty much everything was down for the week. You could look at the Russell, the NASDAQ, the S&P, and the Dow, all down for the week. You can look at Bitcoin, crude oil. Pretty much everything was down this week. Yet at the end of the week, I had positive gains in all my accounts. So it's one of those things you just go, yeah, I did things right. Going against the grain, going with the grain, and still managed to eke out some gains when there were some pretty significant losses around the board. And cheers to Jerry out in Greece. I wish I was with you in Greece right now. I love Greece and the islands. Just give me some islands. I'm close to the beach out here in Southern California, but not quite as close as Greece with all those islands. All right, let me get into today's topic. Obviously, it's a trading week wrap-up. I'm going to go through a bunch of listener questions I received from you. Of course, I'll go through as much as I can here in the chat room, but I'm going to start with a little bit of this. Talk about the trading week wrap-up, but also notice that logo on the side there. We have the Ethereum merge. Now, I did a show a couple days ago talking about the Ethereum merge and why it's so important. Probably one of the more significant developments to happen in the history of crypto. Just something that no one had ever seen done before, where they transitioned from one technology to another. And I'm a dork. I'm one of these guys that loves to absorb all that information. And instead of reading someone's headline about what happened, I was in the weeds as that transition happened. Meaning, I was sitting there watching Vitalik Buterin and his developers all on a giant conference call around the world, sharing information, looking at the data profiles of Ethereum and making sure that everything went smoothly. And it went absolutely smooth. So no problems, no hiccups, which is great because that means down the road Ethereum has a much greater prospect of expanding. However, in this transition, there's a fear now that Ethereum is going to be classified as a security, which Gary Gensler is starting to beat that drum that, well, now Ethereum is centralized because of the miners. So let's take a look at crypto to start things off. I know we don't usually start there, but I'm going to run through the list. Ever since Ethereum did the merge, it's been an absolute bloodbath. It's been really ugly for most cryptos. Today was a few of them were to the upside, but let me get to Ethereum here, and we'll start with that one just to kind of put it into context of what happened after the merge. And there's a lot of people that say, buy the rumor, sell the news, right? Well, if you look back when that merge happened, it's right here. It started looking pretty good and then just fell apart. Now, I still think that Ethereum is long-term. We're talking years. It's going to do great. I have no worries about Ethereum in the long run. In the short run, maybe this is a bit overbought where people were trying to capitalize on the potential fork that happened with Ethereum and seeing how that all went. I have not received my ETHW shares yet, for those of you who might be asking. I can actually check here in a second to see if I got them, but I don't believe I did. But ETHW was the fork. So, where we think we're going from here, I think that it'll probably hold. I think that there's a little bit of an over sell-off here in Ethereum and crypto in general. We can start with the Ethereum chart, which obviously doesn't look that great, still on a major downtrend going back to November of last year. Then you can also go to the other big daddy, which is Bitcoin, which surprisingly has come back and re-challenged those lows. Now this week, obviously very ugly with pretty much following the footsteps of the market. We had that nice big sell-off earlier in the week and looking pretty painful. Now again, I'm still focusing on this 18,000 mark. We get below 18,000, get a close below that, I think we're in trouble. I think we could really be in a much more significant lows. Taking Ocean Beach, 72, and listen to Merlin Project. 72, huh? I wish it was 72 here. A little bit hotter than that, but a beautiful day in Southern California. The sweat has subsided just a little bit. So we could run through a lot more of crypto should you guys want. Let me know. We'll discuss it later on, but I want to make sure I get to all the major market indexes. As I mentioned on the weekly chart, let's bring up a weekly here, and I'm going to run through our top 7. You notice this most recent candle for almost everything is a big, ugly red candle. Here is the weekly for the Dow. And a complete engulfing on the weekly, which would have Bob Dunn jumping for joy because he loves engulfing patterns on the larger time frames. Here's your Russell 2000. Again, an engulfing pattern, but really 3 weeks in a row where we've kind of gone nowhere. We've had big ranges, but at the end of the day, we're really not going anywhere with regards to the Russell. NASDAQ, overall net loser for the past 3 weeks. You go back to past 5 weeks, and it's been just pretty much a net loser as well. So another engulfing pattern there on the NASDAQ, but a huge down week. Here's gold. I'll run through with some of my portfolio positions as I talked about it on Thursday or Wednesday's show. Actually works out pretty well for most of those positions, but I'll show you which ones got exercised or will be exercised here. So the gold one is probably the one I'm most interested in, because you notice we've kind of done this triple tap at this level at 16,000. Or sorry, 16,000. I wish gold was at 16,000. 1,673 is where we bounced off of this week, and it's not looking great. I'm kind of hoping this toes the line. I will own GLD shares as of Monday, and if we get a close below 1675, I will probably get out of mine. I'm not quite sure if I'm going to be selling some call options on that one to protect my position and get a little bit of, not protect, but to earn a little extra income, but I'll have to make that decision on Monday. Here's your S&P 500. Again, another giant engulfing pattern there. You had the crude oil chart, which really is just continuing this weekly drift down. I know if we look on the daily, it looks slightly different, but let me go to Bitcoin's weekly, and then we'll wrap this up. And there's your Bitcoin on a weekly, really just traversing sideways for the better part of almost 3 months now. Now, I like to look at the daily. That's my favorite chart to look at. Here you can see the steep slide that we've seen in Bitcoin, and obviously for anybody who's long Bitcoin like myself, it gave back a lot of gains this week. Now, the one that is most interest for me is the S&P 500. So here's your S&P futures. I know a lot of you like to look at SPY, so we'll look at SPY, which does not have the hammer formation. Somebody asked me about this earlier and said, what do you think of the hammer formation on the S&P? Well, it's not on the SPY, it's on the futures chart, which certainly is a hammer formation, and the markets are closed, so we'll have to wait and see how this opens up on Sunday night. But all my rules would still apply to this, and you guys know my rules. If it opens up below the top of today's candle, which is September 16th, if it opens below, at or below, let's see, the high point there, which is 39.05, great. Then you're just waiting for it to start to move back up. If it breaks those highs of 39.05, then you got a potential long trade. But the way we finished today really was a positive sign. Let me bring up the 5-minute. Notice how it was it felt like we were compressing and just getting lower and lower and lower. This is a 5-minute of the S&P 500. And then that last hour and a half, it really just felt nice and strong, higher highs, higher lows, and things were looking great, and finished on a very high note, closing it right around 3,900. So it's unfortunate that the markets are closed, because with that kind of momentum, that would normally carry through into the next trading session, but now the markets are closed, so we don't have to worry about that until Sunday night. All in all, I'm feeling relatively optimistic. So let me go through here and explain a little bit on those current positions. I'm going to run through the options side of things I showed you yesterday, and I think that's all of the ones I have currently. And I highlighted all the ones that are expired today. So you can see I had the triple Qs. I sold the 312 calls. That expired worthless. I collected a bunch of premium on that one. You notice the XLE. This was these are days I love, right? A lot of times you're either in the money or out of the money by a good amount, but these were so damn close today. Here is, I'll do it on a 15-minute time frame for you guys. And let me turn off the extra hours trading, and we'll go regular hours. So here is a 15-minute chart of XLE. As you guys know, I sold the 77.50 puts, which actually, as of today, it had been there, right? We actually came down to it, and we hit the 77.50 mark, and I was like, oh, I might own those as of Monday, and then the market rallied out. So those options will have expired worthless. Thank you for paying the premium. Whoever bought those from me, I appreciate it. You made a nice little chunk of my week. I also had XLF, right? And as you can see here, XLF was at 33 bucks. This one, talk about by the skin of your chin. We were underneath 33 all day. And I was like, okay, no problem. Because for those who may not understand, with options, when you sell a put, if it closes below the strike price that you sold at, you're going to be given those shares on the following trading session after expiration. So options expire today. If XLF closed below $33, if it was at $32,999,999, I would own XLF physical shares in my account as of Monday. Well, look what happened the last 30 minutes of the market. Had this nice little rally up. It broke above 33, closed at 33.06, so 6 cents away. Therefore, I get to keep all my premium, and those options expired worthless. I love selling ice cubes. Sell ice cubes on hot days. Let them melt and disappear. Next one on the list was Bed Bath & Beyond. You think the XLF was closed? Check out this Bed Bath & Beyond one right? Now, I had zero interest in holding, or I could care less about Bed Bath & Beyond. I just collected $2.50 worth of premium on an $8 security. That's insane. That means my average price was $5.50. It made no sense not to take this trade. And you notice today, we were bouncing off that $8 mark, and we've actually been doing that for the past couple days. So very happy to see my $8 strike price on Bed Bath & Beyond expire worthless. And the last one, again, it was just jockeying around my strike price. $157 was my strike price for that one, and started off below it, which means I would have owned XLY as of Monday, closed in nice territory. So the only ones that executed that are against me at this point is GLD. I'll show you the screen here so you guys can see that one. I have that in red. So I sold puts on GLD 161.50. I'm long-term bullish on gold. I think it's got some problems right now. But let's bring up that GLD because this is the only one I have to really work on. Let me go up here. So 161.50 is that top line there. And I was wrong. I actually got $2.50 per. I thought I got $3.50. So $2.50 would make my average price $159. So that's my average price on this one. Meaning, with the premium I collected by selling those options, anything below $159, I'm actually losing money. Now, as of Monday morning, I will be long GLD. It's going to be in my account because it closed below my strike price, and I'm not worried. I'll evaluate it on Monday and see what happens. I'd love to see a nice rally up on Monday so I can maybe sell the 159s or the 161s and put myself in a position where I can lower my cost average even more. So not the best trade in the world, especially considering what's going on with the dollar and the overall trend of gold. Here's the market price of gold. You can see it has not been great. Breaking down below those lows just doesn't bode well for my position, but we'll have to do damage control on Monday, and I'll keep you guys updated on that one. So just wanted to share that because I know a lot of you, I got a ton of emails about last Wednesday's show asking me to do that more regularly. I'm probably not going to do that all the time. It's just, I'd rather talk about markets overall, but every now and again, I'm happy to show you positions that I'm in, especially when I got a bunch of them on. I like to load up and kind of hedge myself. The one that's really been probably the best of these ones has not even been something that I sold. It was been XLB, right? XLB, I bought puts on XLB, and it's just been falling ever since. You do have a hammer formation, so I'll watch this on Monday. But my options are set to expire in December, so I have plenty of time for these options to pan out, which means I will get out no later than the third week of November on this one. But all in all, so good. Just treasure hunting for Merlin another day in the... Isn't it what we're always doing? Isn't it always treasure hunting for all of us, Jerry? I mean, it's... We're all treasure hunting. We're all just trying to get a little bit here, a little bit there. Every now and again, we catch a lot. Hopefully, we don't lose a lot. That's just the nature of the game. Yeah, I agree with you, Big Gab. GLD at 159. It's not one of those ones I'm like, oh man, I'm really worried. I'm so scared. I'm freaked out. I'm not that. No big deal. Especially if you look at the amount of premium that I collected, like by selling those QQQ calls at 312. I mean, that was a big chunk of change for just a couple of weeks. So anyway, wanted to share that with you guys just because it was fun and entertaining along the way. Now let me go back and show you what happened today because I want to go through a couple of pieces of economic data. Here's your data that happened this week. You start at the top there, you look at retail sales for the British pound. So GBP USD has not been doing well. I saw some conversation there in the chat. The British pound has been on an aggressive slide. Here is the British pound. We had David Warner on, I don't know, it was probably last year or something, and he was like, I think it was actually as this thing kept drifting up. Time flies. It was back in 2020. He's like, I'm bullish, and he's since changed his tune, and I mean, now all of a sudden the British pound just giving it up and plummeting. The last time that we were this low, we were at 114, was 2020 lows, and I'll show you the weekly here. Notice that right there. We are actually lower than we were back in 2020. And just for anybody who wants a personal or a reference point here, hey, good to see you, Doug. The last time that we were lower than where we are today on the British pound with regards to pound versus the dollar was 1985. So let's see, that's 15 plus 22. That's 37 years ago. is the last time that the pound was this weak. Now, I don't know if, let me see if I can bring up that much data here, just so you guys can see it. I'll bring up, this is all the data I can get on a monthly. And you can see back here in the 70s, the pound is really strong. It was over 2 to 1. And then from 1980 to 1985, that 5-year span, the pound went from 2.44 all the way down to 1.06. That's over a 50% drop. Now, I have this blue line here, which I think right now is not very interesting, but we've never been at parity. Never seen the British pound at parity, and it's a very real reality. I think it's interesting to keep your eye on that one as this trend keeps showing weakness and the dollar keeps gaining in strength. We may see this British pound US dollar pair get down to parity, but I thought you might find it interesting that the lowest it's been in 37 years and the lowest that it's ever been was 105. I will show you right here. 105.20 is the lowest that it's ever been, and that was again back in April of 1985. Crazy. So I'm hoping that it keeps going because it would be nice to make a nice trip over to the UK. That said, their economy is not looking so good. I started off talking about this economic data here. Retail sales at the top. They were expecting a contraction in retail sales, right? Going from 0.4% to negative 0.5%. So they're clearly expecting their economy to slow down with regards to spending, but it was way worse than expected today. Down 1.6% on retail. Now again, that's 1 point data. Yay, crappy cars and bad music, bringing the 80s. Hold on a second. Bad music? Are you gonna start bad-mouthing Culture Club and disco right now? Hold up a second, Glenn. Don't knock disco. Nobody hated disco. Disco is like the happiest music. It's like, hey, let's just go to a club and dance. And hey, you got some drugs? Sweet, let's party. Nowadays, you got this sappy country music where it's like, oh, my dog left me and I'm sad and my girlfriend's cheating with my dad and oh, I got a tear in my beer. Come on, man, I need happy music. Let's go have some fun. Well, I arrived, Tom, in the 80s, right? It was the 70s or 80s. Anyway, my stand-up routine is over. We'll go back to the charts. With regards to Europe, you have their final CPI numbers. Came out in line with expectations, and this is actually really good that you don't see any fluctuations from expectations. So the euro, just like the British pound, has been getting shellacked. I will bring up the euro for you as well. We are back above parity, but pretty much sitting right at it. There's your Euro USD. Jerry says the Euro USD is reaching sub-level 1-to-1, think 90s in the near future. I agree with you. If you look at this monthly on the Euro USD, it's not a pretty picture. Now, if you are looking at the monthly, and again, this is not a closed month, it's still just the middle of the month, you have a real long spinning top here with long topping and bottoming tails. To me, that trend is still strong, and I do think you'll probably see it drift down into the 90s. You know, the low points that you had back here in 2002, this is as I was living in Europe and enjoying Italy, that was right around 95. After that, that you're really looking at 86, which is literally what it was when I first moved to Italy, was at 0.86 to the dollar when I signed my contract. So that would be crazy. I'll be heading over there in 2 weeks, spending 2 weeks over in Europe and traveling through Germany and Czech Republic and etc. Should be a good time. And I love the fact that my money goes so much farther than it did just a year ago. So I'll be able to do a lot more, even though it's expensive as hell to travel through Europe. Merlin, are you going to be buying euros now or waiting for the price to fall even more? I'm just kidding. I'll buy them when I get there. I'm not so concerned about that. I mean, I'm not worried that the euro is going to go back up to 125, right? That would be like a crazy move. It'll probably hover somewhere around parity, so I'm not so concerned. Like if I was going to buy a house, making a major purchase of hundreds of thousands of euros or dollars, then I might reconsider and maybe be locking in this rate. But Europe's not in a pretty shape either, and we'll talk about TIC long-term purchases here in just a second. Do you think their economy is pointing to what will happen here soon? No, I think that the U.S. is still the dog that wags the tail. I think that other economies, I think that Europe is in far worse shape than the United States, even though we did way more monetary manipulating than the European Union did. I still think that we are in a far better place as a government and as an economy than the European Union. To me, it's just too fragmented. It's so difficult to get that many cultures to work together, and it's tough. It's a really tough situation for them to be in. Let's see. Robert says, with the Dixie too strong and all commodities are priced in the dollar index, will that not keep inflation high? Well, no, it's kind of the opposite. So we'll digress here a little bit. I'm going to go back to this economic data. But if you look at the dollar index, right, we had today wasn't the best day. Let's go back to the daily, right? We're just kind of chopping sideways here. If the dollar keeps rising, I mean, part of what the Fed is trying to do is remove money supply. You take money out of circulation, and that means generally less money to spend. However, there's certain things that are causing more people to look to buy dollars. So the government, the Fed, not the government, but the Fed, is removing money supply, right? They're doing quantitative tightening. They are selling bonds, taking the money from those bonds, and putting that money back where it was created from, out of thin air. By taking that money supply out, you have fewer dollars in circulation. But as I pointed out, you now have other countries, Japan, hell, Russia, Europe, that are looking to do something with their money. And they're not earning yield in their markets because their bond markets are still depressed. But now I can jump over and I can go buy a 10-year U.S. bond, right? Let's say I want to buy a 10-year bond in the U.S. and get 3.5%. So now I'm going to go buy U.S. bonds, but I can't do that with my euros. I have to convert my euros to what? I got to buy dollars. So now you have people that are buying these bond products to get yield, converting their currency into dollars, which drives the dollar up even more. So it's not necessarily that the high dollar price is the inflation issue. It certainly can hurt things. Now let me go back to that point that you mentioned there, Robert, about it impacting commodities. It should have the opposite effect. So as the dollar keeps rising, like it is here, this is the 10-year, as the dollar keeps rising as you see it is here on just a beautiful uptrend. I mean, honestly, everybody wishes you're along. Well, we are along the dollar, right, for most people here. If this keeps rallying up, what that's going to do is that's going to have bearish pressure on commodities. Not bullish, bearish. And what I mean by that is you look here and go to, let's say, cotton. All right, here's the cotton chart. Let me put this on a weekly so we can see a bigger picture. But here you can see cotton. It was on a huge inflationary bubble, and all of a sudden it's come down significantly. And these factors, someone actually was coming after me the other day saying that the commodity prices don't matter. It's just about oil with regards to inflation. And that's not true. Oil is certainly a big part of the inflationary discussion, but cotton, lumber, natural gas, all of these things make up products and services which are inherently going to impact inflation data. So the stronger this dollar gets, the weaker you're going to see cotton, lumber, man, just taking on the chin here. Natural gas, right? Natural gas is probably the outlier here. And the reason I say it's an outlier is because of what's going on with Russia. I would contend that energy prices, even though a strong dollar should impact those negatively because of supply constraints around the world. Even with the strong dollar, natural gas and crude oil should continue to rise. Thank you, Putin and Russia. You have things like corn. Right, so corn has actually been on a pretty decent bounce, but it came down significantly from those highs back in April of this year. You have soybeans, right? Soybeans also fairly depressed. You have wheat, which is starting to move up a little bit, but a strong dollar makes these ones weaker because anybody who's buying these commodities internationally needs to convert into dollars, and they will be able to buy less commodities with their currency. If that doesn't make any sense, let me know. I'm hoping it makes sense to everybody out there. I know it gets a little confusing, but remember, anybody who's buying those commodities needs to convert their foreign currency into US dollars to buy those commodities. So if a year ago, my €1 would have bought me $1.50 worth of wheat, and all of a sudden I'm at parity, my €1 buys me $1 worth of wheat. And that's obviously not good for me as a foreigner buying commodities. But is that fake money to begin with? Yes. Let's see, government's selling these bonds at a loss compared to what they paid. That's a whole different discussion. Maybe we can have that debate with Bill Addis. I'm pretty sure Bill's going to be on, heck, I got to find out. I think he's going to be on next week. Next Wednesday, someone's asking about when David Warner will be on. David Warner's going to be on Wednesday's show to talk about the Fed and interest rate announcements and currencies. He goes, he's one of the Forex traders, or he's a Forex trader, teaches for Online Trading Academy as well. Here's one more stat to help verify this, but I'm hoping, Robert, that helped clear that picture up. You said here, but with a dollar too strong and all commodity prices are priced in dollars, will that not keep inflation high? It will actually drop inflation. The higher that dollar gets, the fewer dollar commodities are going to get purchased. In theory, right? That's the macroeconomic perspective of it. But look at some other pieces here. I'm just curious, how many of you know what TIC long-term purchases is? It's an economic data point that most people overlook and don't think it's important. Just simple yes or no. Do you know what TIC long-term purchases is? I'll wait the ungodly delay I have here on YouTube that YouTube puts in, not me. Just curious if you guys know what TIC long-term purchases is. Most people don't. Now let me explain why it's so important. TIC long-term purchases basically says how many US dollars worth of foreign, like if are Americans going out to other countries and buying their securities and long-term securities versus how many foreigners are buying US long-term debt and securities. So it's basically saying who's buying whose market. And if you have a surplus, let's say that more foreigners are buying US bonds and equities or securities than Americans are buying foreigners, that should be good for the US economy. That means that that's the hot spot. People are buying American goods and services, great, right? Buying those stocks. If it's a negative number, that means that Americans are actually buying more of foreign securities, long-term securities, than the foreigners are buying of the US. So it's really saying who's buying where. And to me, it gives you an indication as to the sentiment about the economies. If you have foreign countries just loading the boat on US securities, that means their optimism on the US equity markets and securities markets is bullish. Why would they be buying otherwise? If all of a sudden it goes the other way and Americans are buying more of foreign ones, it paints the picture of our economy's not really doing that well, and maybe the forecasts going forward are rather bearish. So TIC long-term purchases came out today. And here you can see at the bottom, the previous number was 121.8, meaning that there was $121 billion more that foreigners purchased of U.S. securities than Americans purchased of foreign securities. This is, to me, in my opinion, this is a very bullish sign for our markets. You kind of want to see that. You want to see people buying U.S. equities and long-term securities. Notice what happened. We dropped significantly. The expectation was we were just going to drop a little bit, go to 121.6 billion. Now it's only 21.4 billion. That's $100 billion less of foreigners buying long-term securities for that month. Now, that may not seem like a lot, but $100 billion of securities. And if we look at securities, well, what I'm talking about is this list over here. That's people buying home builders and energy and financials and industrials and technology and utilities and healthcare and consumer staples, right? That's securities. And if they're not buying that stuff, that is a demand aspect that's declining significantly. And 100 billion could have a big impact on our markets going forward. So I thought that this piece of data is one that I think most people overlook. They don't normally look at it. This was a drastic change today. I don't have the chart up here. Let me see real quickly if I can find this one for you. And by the way, is anybody here into like jazz or just really good instrumental music? I'm listening to a song. It's one of my personal favorites, and it got me so fired up today. I love this song. It's probably one of my personal favorite songs. It's called Also Sprach Zarathustra. Also Sprach Zarathustra is this theme song to 2001, which by itself is entertaining. But if you want it, I'll post it in the chat. It's awesome. It is such a good version. Anyway, here is the TIC long-term purchases. And you can see historically, I'm going all the way back here to 2006. We don't have many occasions where the U.S. is buying more of foreign goods and services, right? That's anything below the zero line. That means the U.S. is buying more of foreign stuff than foreigners are buying of U.S. So it's normally, we need this to be on top. Well, let's zoom into where we are right now. And we've seen a pretty quick decline. Now, this is 1-point data, but keep your eye on this for, let's say, the next 3 months. Let's watch this through the end of the year. If this continues to decline and start to go negative, well, I would argue that that's a trend, meaning that the foreigners are not buying our stuff, and that would not be good for our markets going forward. So I thought that would be an interesting one to share with you. And if you want to rock out tonight, not right now, do this after the show. This is probably one of the most impressive jazz rock songs here. It's called Also Sprach Zarathustra by Deodato, a famous musician. But have fun with that one. I enjoy it. You know, little music to liven up your day after this program. Put it on and dance around the house with a glass of whiskey and go, "It's Friday! It's Friday!" All right. Let me keep going. You guys expecting to freeze this year? I know, Jerry. It's funny. My girlfriend and I are going over to Europe in 2 weeks, as you guys know. And we're starting in Munich, where I was born, and it's going to be cold. And then we're going to Prague, visit some friends there. And we're going to Berlin to meet some friends there, and then Amsterdam to meet some friends. And it's like, Europe's cold in October. And I was reading that Europe is actually going to be imposing fines, specifically Germany, saying, look, if you keep your thermostat above 19 degrees Celsius, you're going to get fined, because they're trying to ratchet down consumption of energy products. What's going on with Russia? And I'm like, well, this changes the our luggage scenario. I was just going to go with a light little jacket. Now I'm going to go with a snow parka and look like, Kenny from South Park. Oh, it's going to be an ugly one. Yes, Doug, that is an oldie. It is a very old song, but it's just very well done, and it just kind of keeps you grooving. I love it. Great, great track. Okay. What else did I have for you guys today? That's right, they got no gas. It's not looking good. Let me go to listener questions. What did I have here? Let me go to this question from Jeff. As you guys know, and you're seeing evidence of that, is I'm really trying to keep whatever my option strategies are as basic as possible. I don't want complexity. I don't want to overthink them. Part of what I'm hoping to do is I want to get to the point where I can do one day of analysis and execution. If I can do one day a month where I do my analysis and execution and then literally don't look at the markets again for another 30 days, that's the goal. Now, of course, I'm addicted to markets. It is an addiction. I'll own it. I love it. So I probably won't, there's no way I could not look at the markets, right? But I don't want to be sitting in front of my computer all the time. I'd rather be traveling or going to the beach or something like that. So this question from Jeff is a good one. He says, in your builder's position, can you walk through your process for calculating your trade, since you now have to consider the cost of the option? I don't consider the cost of the option at all. Jeff, options are, a couple bucks, big deal. I'm not worried about that. I mean, if I'm selling an option, and let's say on this one option, I'm looking to make $500 on just collecting premium, and I pay a $2 commission, I could care less. It doesn't make a difference. I'm not selling an option where I'm going to make $2 and pay a $2 commission. That would just be silly. It's not enough meat on the bone. So I definitely am keeping things way, 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 way simpler. Now, you're asking here about me, do you also use some kind of rule that if the option will pay you half of your expected return to sell and move on? Nope, I don't. I let them go to expiration. I mean, you guys saw it today. I mentioned on Wednesday's show. I'm just going to let those options go to expiration. So today, Bed Bath & Beyond expired, worthless. XLF, XLE, XLY, all expired, worthless. I'd rather not incur that second commission, even though it's only a couple of dollars. But let's see. Don't get duped into buying a smart thermostat. Oh, no, I don't trust Edison anyway. They continue offering charge every 10%. Wow. Interesting to know there, Michael. I did not know. I don't trust Southern California Edison anyway, but no. So, Jeff, yeah, I don't have a rule for that. If I'm selling those options like I showed you in that list, my expectation is I'm okay to own it if it gets down here, right? We looked at XLF, looked at financials. I'm okay owning it at 33 because as soon as it hits 33, I will sell calls against that and try to get my cost base as low as possible to generate more income stream there. So, but there is no, if it gets 2-to-1, or I don't look at getting out of them. I'll hold them to expiration unless something drastically goes wrong and I'm like, this is going to continue down big time. I'll most likely just keep them all the way through expiration. All right, what else are questions I have here? I kind of answered this one a little bit ago. Scott says, how is inflation so high and the dollar so high? Wouldn't a strong dollar make things here cheaper? Well, I have to say, I think that we are in a very unique time. I think that the dynamics that normally worked are broken. And if there's actually a really good comment made by Muhammad Al-Arian, who I highly recommend everybody follow on Twitter. He's one of those guys, he's kind of an oracle, and he really has a good read in the economy. And he says, get out of the markets. Get out of the markets. He goes, you're seeing everything is disconnected. The relationships between bonds and equity markets seem to be broken. The relationships between commodities and the dollar seem to be broken. I mean, he's going, I've never seen anything like this, where you have such a crazy disconnect and separation of historical correlations. I agree. I think that for the most part, you should just kind of step back and either say, I'm going to buy and hold, or I'm going to just get out and go to cash. To Scott's point here, he says, so how is inflation so high and the dollar so high? Well, the problem I personally think is because of the rate of increase of the dollar. It's not that we've been slowly increasing money supply. As you guys know, from 2020 through till today, they put in $15 trillion in the economy, whereas the previous 70 years, they put in 1.5 trillion. So you have this massive residual flood of capital that's still out there in these markets driving prices up. It's consumption. I think what will happen is it's going to slowly take some time to get that money supply out of the economy and roll inflation over. It's still accelerating. It's like the fire could be out, but it's still burning. It's going to be smoldering for quite some time before you get inflation under control. And I would argue that it's not under control quite yet. The point, one of the comments was on, I think they actually sent this to Online Trading Academy, was on crude oil. Well, crude oil, while it's down on the weekly basis for, since May, it's still had a huge rally up. This is still impacting our economy as a whole, and it doesn't mean we're out of the woods yet. I'm hearing people say now we're going to have $2 gasoline. Come on. That's not going to happen. There's no way the Saudis and OPEC are going to go, we'll let our gas go that cheap that you can now have $2 oil. If anything, they'll play hardball and try to push it back up to 5 or 6 because they control so much of it. So yeah, I'm not exactly sure why you're seeing inflation still as high as it is. I actually thought it would be drifting down a little bit more. The previous reading of Consumer Price Index, I was actually expecting it to come out that our inflation was declining a little bit, right? Just slowly tipping down because the previous reading was so big, such a big decline. And as I mentioned, a lot of these commodities have drastically sold off. However, if we look here, this is lumber on the weekly. Let's do a monthly just so I can give an idea of when these indexes might be reporting. So here you can see lumber's been falling for 7 months straight. So that's good for inflation. That's going to bring the cost of construction materials down, etc. Here's natural gas. Well, natural gas has had 1 month of down. Otherwise, it's been aggressively up. Cotton, right? You had those 3 months where it was really, really, really big down. 1 big month up, and now we're trending back down again. So let's see, where's natural gas? Corn, right? Corn, past 2 months have been up. So this is obviously going to start to impact inflation again to the upside. Soybeans, that's not too big of an impact. Wheat, I would argue, will be one going forward. His name is Muhammad Al-Arian. Let's see if I can get his Twitter feed up here real quick for you guys. It's a strange name, but see if I can get it. No. I'll have to, I may have to get that one for you a different time. I hate trying to search for things live during the show. Does lumber lead the housing market? That's a good question. I guess I don't have empirical evidence on that, but how would we look at that, Margaret? That's a good question. How would we look at that? Well, one thing that I would do, and unfortunately I can't do it with these charts here, is I would do a side-by-side comparison and say, let's look at the price of lumber. Here's a monthly of lumber. And then maybe I look at somebody like Toll Brothers, who's a home builder. So let's go, convert this picture to your memory here and see what this looks like, and then go Toll. And I would say not really. Certainly, Toll Brothers has been selling off, really since it peaked in December of 2021. Well, lumber, it kind of peaked in December 2021, right? That's this point right here. But it was already selling off before that. So, exactly, they should be the opposite. So where lumber costs were rising here from September, October, November, and into December of 2021, Toll Brothers was still doing pretty good, right? It was going with it. So I don't know. I'd have to look at the longer term and put them side by side. I don't like to do this, but they should be the opposite, as Karen said. If you have rising lumber prices, that should put a damper on Toll Brothers. However, there's other factors. It's not just, if we look at the factors for home builders, right? What are the major factors? Construction cost, and in my opinion, interest rates. So if the construction costs increase, let's say the cost of those homes for Toll Brothers to build, let's say they've got a house that's $500,000, that's their list price, and lumber increased by 25%. Well, they might say, okay, well, this house was $500,000, now it's going to be, $550,000. They're going to pass that cost of the increased lumber off to you. Does that impact Toll Brothers stock? No. Right, they're still going to make that margin. What impacts Toll Brothers is when consumption of the homes themselves starts to decline. So it's not like most of us don't look at buying a house and go, oh crap, I'm not buying this thing. See how expensive lumber is? No. You look at you go, man, I can get a 30-year fixed rate mortgage at 3%. I can buy this house, right? That's what people are thinking. So I think that a bigger driver of what's going on with Toll Brothers and seeing the sell-off here would be looking at something like the 10-year and saying, how is that impacting current markets? Let's see what that might look like. Notice that we've had since 2020 on the monthly, that 10-year has gone from 0.3% to over 3.25%, right? We're almost 3.5% right now. Well, Toll Brothers has been selling off pretty aggressively since December when those rates really started to spike. So I think that's probably a bigger measure as a leading index for Toll Brothers, Lennar, KB Homes, etc. Thank you, Margaret, for getting that one. Yes, it's I can even post his Twitter feed. I just was having a hard time typing it in here, and there you go. So here is his Twitter feed, and I will copy it over here. So if anybody wants to add him on Twitter, which I think you should, there you go. There is Muhammad Al-Arian. That's his Twitter feed, and he is just, I don't know. I feel like he's just an incredibly sharp mind in the space, and when he starts talking about stuff, just, you know, obviously it's an opinion, but read through it. He always has very sound advice, I think, about the markets. Here, like, look at this new one. 7 hours ago, he says, forget about economic forecasts. The FedEx warning and the immediate 23% fall in stock price are making the U.S. stock market focus squarely on global growth fragility and the Fed policy mistake. He's already calling out the Fed. And in a manner that may be hard to shake off quickly. So, you know, he's definitely looking at what's going on with FedEx, but addressing the global growth concerns, addressing the Fed problem. So anyway, I love it. All right, that's it. Anyway, we could spend tons of time just talking about Muhammad Al-Arian. Let's see, what other questions I have? This is a simple one. Nick, you asked me if there's a way for you to break down how to move crypto to a cold storage. That's very simple. Right? Moving crypto to cold storage is very, very simple. You open your cold storage device, and you say deposit, and you copy that deposit address, and then you would move that over to, let's say, your Coinbase and say, okay, Coinbase, I want you to send my crypto to this address. And you put your cold storage address into whatever you're sending from, and then that transfers over. Pretty easy. Maybe I can show you an actual transfer sometime, but it's kind of a pain, and I'm a little wary of showing. In the CIL, I do it all the time because it's behind a paywall and it's got permissions to get in there. But showing live accounts and data stuff, I'm not so keen on a public channel like this. Last one, Michael. Another great question. He says, I finished reading the reminiscences of a stock operator book that you recommend. Wild that he didn't. Wild what he did. But what are those bucket shops? I don't think they're around anymore. So I'll start with that. Bucket shops basically were little casinos. They were basically a little building you would go to, and the wall would just have quotes of different stock prices. And one of the main reasons that Jesse Livermore did so well is obviously reading the tape, understanding price direction, but he had relays and spies kind of set up between shops. And, you know, you could go a couple blocks over and they had different prices. So he'd be hedging, not hedging, but taking advantage of one location versus another. And if one location was selling something at $10, and he could buy it at the other location at, let's say, 9, he'd load up everything he could here at 9 and then get over to the other place and sell it at 10 before they could communicate. So it was just, it's archaic, it's gone. Remember, that was in the late 1800s. Is there anything equivalent to that today? No, I don't think there's anything equivalent to a bucket shop today. It's simply just, in my mind, a gambling hall, like a sports book in essence. But nowadays, the sports books are connected all digitally. There is no arbitrage opportunity. Really, Jesse did a lot of arbitrage and exploiting price discrepancies between bucket shops, and he got caught for it. And, you know, the king of arbitrage. Yep, exactly. Also, the second part of it is also, do you know much about Fibonacci levels? Do you ever use them? I saw a Wall Street Journal article discussing how the recent S&P moves match the Fibonacci perfectly. Wondering if you could discuss what they might mean. So, yes, I do like Fibonacci. As everybody here knows, I do my best to not let an indicator or an analysis tool tell me what to do. It's more important for me to look at price charts and say, what is the price chart telling me? You know, I could look at this chart here with Toll Brothers, right? I can look at this chart right here of Toll Brothers and tell you that on this monthly, it's coming into this area of consolidation I'm going to draw a yellow box around it because it looks like for this window of time right here that there was some pretty good consolidation, and we're right in it right now. So my feeling would be that Toll Brothers, just based off of price alone, forget about economics, is at a point where it's probably going to see some stabilization, and if it gets back above this yellow box, I'm going to go long. If it goes below, I go short. But what a lot of people do is they look for ways to support their opinion. So look, I can go here from the lows of this move on Toll Brothers that happened back in March of 2020 and go to the high that happened here in 2021, and I go, oh, see? It's exactly a 50% retracement. Oh, there it is. See? Yep. I'm going to buy because of that. Well, look, you can make that argument about everything. I can bring up any chart and add fibs to it. Retracements are interesting because there is some strange mathematical phenomenon to them. I do believe that Fibonacci is a useful tool, but I don't want people to get in the habit of using it to make decisions. I mean, let's go look at Tesla. And I'll go to a daily time frame here. I don't know why I chose Tesla. Not really anything noteworthy here to speak of. Let's go. How about Apple? Okay, so let's go to this Apple move. Right, Apple. Keep your eye on this one on Monday. You got a nice hammer formation on Apple. How is the volume on it? Oh yeah, guys, this could be a very nice potential trade on Monday. You have a hammer formation with well over normal volume. It looks like almost double normal volume on Apple today on a hammer formation. Just picture Gollum rubbing his hands together going, my precious. Anyway, I could go to these lows back here that happened June 22nd and pull all the way to the peak there and make an argument that, oh, these fib lines are going to hit. Oops. Oh, great. Hold on a second. And go, oh, well, yeah, let's see. Oh, look at that. It came right down to 68. All right? You can always make an excuse for something. What I like better, personally, is using Fibonacci extensions and looking at something like this and saying, all right, if we have this initial move that started in June, rallied all the way up to this peak here in August, and then sold off, based off of that structure of impulse and correction, where may it be going next? And let's see, do I have extensions on here? Trend-based fib extension. This should be the right tool. So let's say it started there, rallied all up to here on August 17th, and then bottomed out right there. So now what this does is this gives me an expectation as to where this might move to. And it works great for things where you don't have supply zones. Because a lot of times, I like that, John. That's good. As Jordan Matthews says, Fibonacci is best with marinara sauce. Yes, a nice Alfredo al Fibonacci. Buonissimo. Mamma mia, che buono. Anyway, I like to use them from this perspective. But look, if I was looking at this price chart right here and saying, hey, where do I think it's going to go? I'm not using these fibs. I'm looking back here, and I'm looking for some supply zones. I'm looking for an area that it might come up into. And if it coincides with an extension level, then great. I'm happy with that. But, Michael, I do like fibs. I think that there's a phenomenon to them in society and art and beauty. It's really interesting when you look at how the Fibonacci sequence is constructed and the whole golden rule thing. I'm one of the few geeks out there. Can anybody recite the Fibonacci sequence from memory? That is the true definition of a nerd. See, most people think that a nerd is someone who can recite pi, which is what, 3.1415926 some. Fine, whatever. If you can actually do the whole Fibonacci sequence, which of course is infinite, then you're more of a nerd than I am. By the way, Fibonacci sequence is you take a number, you add it to the previous number, and that's your new number. So it goes 1, 2, 3, 5, 8, 13, 21, and then on and on and on and on and on. Yeah, I'm a dork. Let's see, Tom says, Fibonacci is in the design of nature. Yep, 100%. It says my belly button is 61% of my height, and it's also been in art and stuff, which you see 3x5 cards, light switches. I believe if you were to extend your arms out and go wrist to wrist, that's 61.8% of your body height. Your head is a Fibonacci percentage of your overall body. It's really, you're missing one. It's zeros. It's 0, 1, 1, 2, 3, 5, 8, 13, etc. You gotta have the 1, 1 in there because how do you add the previous number together? Anyway, you gotta have the double 1. The double 1 is the one that throws the whole thing off. It's kind of weird, but anyway, that's the fib sequence. And maybe we'll do a special on it. It's funny because I have a couple friends who are really into Fibonacci, but what I don't want to end up being is a sales pitch. So I try to not let people do heavy sales pitches on here, as you guys may have noticed. Some that have done the heavy sales, I don't bring them back on. Just talk about markets. I don't need your sales pitch. Let's see. What time we at? Oh, 51. Tom, Big Eb, you're not getting an hour show out of me, buddy. It's Friday. It's a happy hour somewhere. Okay, let me look at what's going on for... is there anything really good going on Monday? I don't believe... Let me see. I didn't update that page, but real quick, let me just go look and see what's on for Monday. There really, I don't believe, was much happening on Monday, but I will pull that one up for you guys so you can see it real quick. Here's what's happening for the 19th. Nothing major for the U.S. You did have the NAHB Housing Market Index, which, has been kind of fluttering right around that 50 mark. Above 50 means expansion, looking good for housing market. I think we all agree that housing is probably overbought. And due for a sell-off here. The charts reflect that. Notice this is basically optimism if it's above 50, and now we've gotten into the pessimism moment. Notice the last time we were pessimistic with NAHB Housing Market Index was April of 2020 and May, when we had the biggest declines. But wait, what about 2007 and 8? Well, I find this interesting that we look at the housing market bubble, which really popped, 2007 is when most people say it happened, right? 2007 is when the housing markets collapsed. Well, notice that the NAHB Housing Market Index was already falling in 2005. And it was down underwater for a long time before it finally came up. So, not saying anything to freak people out, but it's, we are at a point that's interesting, having just dropped below on NAHB. That was the previous number. They're expecting it to be another month of negative, and we'll have to wait and see if this continues to be a longer-term downtrend, which would mean the housing market is going to continue to slide even further. Now, if the housing market continues to slide further, what's that mean for the market? It means markets will be going southbound. Right? The more that the housing market declines, the more people are underwater on their mortgages, the more likely people are going to go into default and foreclosure. People can't make their payments, then people spend less. If people spend less, then that means that employers are going to go through layoffs. So you get that giant cyclical spiral of pain, I guess, for the economy, which maybe is what Jerome Powell was outlining in his Jackson Hole speech, saying people are going to feel some pain for a while. So I guess I got to be careful on how close I sell my puts, because markets may be headed even lower. Tell us about that band Fish and how they use Fibonacci numbers. Fish doesn't use Fibonacci numbers. Fingertip to fingertip is your height. Ooh, nice. I know there's I think there's a famous picture. It's called the Vitruvian Man. Was it by Da Vinci, right? Which is all Fibonacci based as well. Rivers. Thoughts on getting prop firm funding for trading? No way. For me, no way. Here's the deal. When you go to these prop shops, you go in there and you put up some money, and they're generally going to sell you a class. You have to take this class to come on our trading floor and make sure that you follow the rules. So that's how they're making their money up front. They'll charge you for a class. Normally, when you get to your class, if you do well and follow the rules, then they'll say, okay, well, you can trade $50,000 of ours. And then normally, the lion's share of the profits goes to them, and you get the small little droppings. I would say it's a much better idea to trade on your own and trade small and then get better and keep 100% of your earnings. More likely than not, you're going to join a prop shop and you're going to lose money, which means you paid for education, which you're going to throw away and lose. Number two, you're going to start trading from that prop shop's account and you'll start losing their money, which means you're paying for that. No prop shop's going to say, trade our money and if you lose it, it's okay. You're paying for that. And some have it set up that the classic model that was around when I was starting off was you pay $3,000 for a class at this prop shop, and then you go in there and they'll let you trade a $50,000 account. But if you lose $500, they'll kick you off the floor. So it's a net win of $2,500 for the firm, and they don't have to do anything. They don't care about you. If you are good and you start making more money, fine. But trade on your own. Don't use a prop shop. Generally, they're charging you commissions, all kinds of hidden fees. A huge percentage of the profits goes to them. What's the point? And I get it. You may not have a lot of money. Start with a small amount. Hell, if you had $1,000, you could go out there and start trading and buy one share at a time just to get your strategy down, right? Get your platform working, understand how it all works. And yeah, you're not going to make any money. There's no way you'll make money trading one share at a time. However, once you get comfortable, then you can say, okay, I'm consistent. Maybe I can go to a relative of mine and ask for 10 grand or 20 grand or 30 grand or 50 grand and build up a little bit. But do it yourself, Rivers. Do it yourself. I don't like prop shops. I don't trust prop shops. Even the trading floor I worked at back in the day, I had to bring in my own money, which I was fine with. I don't want to trade someone else's money, especially the way that some of these prop shops teach people how to trade. And you almost got me to a 1 hour show. That's going to do it for me, everybody. I got to run. Next week, we should have a full week of shows. I know I'm going to have David Warner on. I'll see if I can get Bill Addis on Thursday. I'm trying to reach out to Ryan Watkins to get him on the program as well. He's got a whole bunch of stuff going on. So, guys are really, really busy. May not be able to get them on the show, but I will do my best to do so. If you guys have comments, questions, feedback, put them down below the YouTube video. I saw a lot of you post comments there, so thank you very much for those that did. You can also email me at TraderMerlin@gmail.com. It is Friday. I hope everybody here does something fun. Live a little bit. Go enjoy your time on this great spinning ball that's hurling around the sun. Hard to believe that we are this small little dot in this infinite mass of space. So make your time worthwhile. Make some new friends. Spread some love. I'll see you guys on Monday. Take care, everybody. Have a great weekend.